3 reasons to double down on Lyft stock before shares shoot 200%. 200%, I think that's a little bit rich. But okay, so they said Lyft stock has already gained 74% this month. And here are 3 reasons why it will still keep on going up. Lyft stock has rewarded investors handsomely in recent weeks. Since the end of October, shares in the ride-hailing company have risen 74% as a slew of good news has cheered on investors. Don't let this buying opportunity go to waste, I wrote back in August, citing Lyft's cheap valuation and robust business model as reasons to buy. Even today, Lyft stock still looks undervalued, but investors should act quickly. It's only a matter of time before the market fully digests the importance of these 3 reasons and sends Lyft stock even higher. Proposition 22 helps the Lyft stock. As Americans voted in the 2020 presidential election earlier this month, California residents found themselves also voting on surprisingly important ballot measure, Proposition 22. The proposition, if passed, would create a statewide category of gig economy workers. These workers would have contractors' freedom, but still receive healthcare minimum guaranteed payments and insurance coverage. With the media's attention turned to the presidential election, few outside the industry noticed Prop 22 did pass, and it's a huge win for Uber and Lyft stock. Not only is California's Lyft's biggest market, the new law reduces shutdown risk and allows ride-hailing companies to push for better legislation at a national level. For months, Lyft shares had sagged from uncertainty over worker classification, leave drivers as contractors, and face the wrath of the media and public over its zero worker benefits policy. But try to give their drivers health coverage, and the Internal Revenue Service IRS recategorizes them as full-time employees who then move to salary-based compensation. Over the years, ride-hailing apps were stuck in the middle, causing courts from California to Texas to threaten service shutdowns. However, the passage of Proposition 22 finally reduces this massive risk. A coronavirus vaccine. Moreover, it's been back-to-back weeks of good news on the novel coronavirus vaccine front. On Monday, Moderna announced that its candidate is 94.5% effective and that it has longer shelf life at refrigerated temperatures. And last Monday, Pfizer and BioNTech announced initial findings that their COVID-19 vaccine candidate was 90% effective. Cyclical stocks jumped on the news. Jets, a U.S. aviation ETF, shot up over 20% at one point in one day. Overall, the vaccine results are particularly good news for Lyft. For months, researchers had hoped for 60 to 70% effectiveness. Given the severity of the COVID-19 pandemic, the Food and Drug Administration openly claimed it would consider vaccines with even 50% efficacy. But such ineffective vaccines would have hampered recovery and ride-sharing. That's very, very true. Better than expected Q3 earnings. And if we look at Lyft's Q3, they were way better than Uber's Q3. Moreover, last Tuesday, Lyft announced good third quarter results. Revenue came in at almost $500 million compared to $496 million expected, while revenue per active rider came in at $39.94. In typical Wall Street fashion, the announcement pushed the company shares up 5%, and far more upside is in store. That's because Lyft operates on a network effect. More riders on the app incentivize more drivers to join, which creates a positive feedback loop. When the coronavirus pandemic hit, investors feared that the feedback loop could run in reverse. Declining ridership could permanently shrink the number of drivers, leading to a collapse of the network. It's how companies like MySpace and BlackBerry folded so quickly and why Lyft stock traded at such a discount. Fortunately, Lyft's Q3 results show the company has weathered that storm, Active riders increased 44% in Q3 to end at 12.5 million. And while that's still lower than Q1 numbers, it signals one thing: the riders are back. That is also true. Why this matters: since its founding in 2012, Lyft has achieved the holy grail that high growth tech investors like me look for: strong network effects that get even better with more users. And while it's been less aggressive and expanding at all costs, the company has still carved out a strong niche. According to a second measure, a financial tracking company, Lyft retains 31% of the US ride-hailing market. Yet both growth and value investors seem to have forgotten the company. Shares trade at barely half of their IPO price, and at $12 billion market capitalization, investors should scratch their heads and ask why a fast-growing, duopolistic company with 30% more revenue than slow growth Norton LifeLock should trade at roughly the same market cap. So collectively, analysts expect Lyft to reach positive EBITDA by 2022, and if Lyft grows in line with market trends, revenues could balloon almost fourfold to $13 billion by 2029. According to a two-stage DCF model, that would make Lyft stock worth around $115, a 200% upside to current prices. Interesting. Additionally, Lyft also presents a tempting takeover target for international ride-hailing firms, as Israeli ride-hailing firm Jet found it's devilishly hard for new entrants to break into an established market, as international ride-hailing and food delivery behemoths like Just Eat Takeaway rebuild the cash hoard. Investors should expect suitors to line up to buy Lyft. I also agree with that. This fall provided multiple golden opportunities to buy Lyft shares at an extreme discount. That said, don't let today's chance to double down go to waste. Very interesting. So I think it'll still go up 200%. Now, huge shout out to my sponsor Cover. KOVER starts at $7 a month. The big thing is, if you get deactivated or wrongfully terminated, they kick in and have their legal arm, LegalRideshare, send out the legal letters. I also got an update from Cover today. Basically, if you have to be an active driver on the network. It's not that you can join Cover because you got deactivated and then try to get them to send the letters out. No, you have to be an active driver, and in the future, if you get wrongfully terminated, then LegalRideshare kicks in. Another big benefit for this gig protection plan is that 80% of your earnings get covered if you end up in hospital, if your car ends up in the workshop. Great service. Their partner, LegalRideshare, and this is a law firm in Chicago. It handles driver cases nationwide. If you've been in an injury, bigger injury, property damage, car got totaled, you've had several months of wage loss, for example, they will handle the entire insurance claim process and go after the insurance company. So hope you never get injured, but if you do, there's really truly only one company that sticks out. They've specialized in the rideshare market. Again, they're in Chicago and they're called LegalRideshare. Just go to legalrideshare.com. Please leave your comments. Have a great day.